You're browsing Zillow at 2 a.m. and something feels wrong. Every decent house that isn't falling apart has a price tag starting with a 5. $500,000 for what they're calling a cozy starter home with outdated appliances and carpet that's seen better days. You start running numbers in your head, comparing them to your paycheck, wondering if maybe you missed a zero on your last salary statement. Here's the truth. You didn't miss anything. The numbers are just broken. The math simply doesn't add up anymore for regular buyers. I'm Mark Reed, and today we're breaking down the real mathematics of home affordability in 2026. Not what the bank says you can borrow, but what you can actually afford without turning your life into a constant financial anxiety spiral. Let's establish where we are right now. In major markets across the United States, Canada, and the UK, $500,000 isn't buying you luxury anymore. We're talking about a standard 3-bedroom, 2-bathroom home around 1,200 square feet. That's the new normal in today's housing market. Cities like Seattle, Toronto, Manchester, or anywhere within an hour's commute of a major urban center all share this reality of inflated home prices. The median household income in the US sits around $84,000. In the UK, it's roughly £35,000 annually, and in Canada, about 90,000 Canadian dollars. We're asking average earners to purchase homes that cost 6 to 7 times their annual income. Let me give you some perspective. In the 1970s, the average home cost roughly 2.5 times the median household income. Today, we're looking at ratios of 6 times, 7 times, even 8 times in hot markets. That's not a small shift at all. That's a fundamental restructuring of what homeownership means. The entire equation has changed for an entire generation of buyers. But mortgage brokers keep saying you're approved. Your parents keep telling you they bought at your age. Social media is full of success stories, people sharing their home buying journey everywhere you look. So what's really going on here? Let's break down the actual numbers. Let's start where most dreams end, the down payment. The traditional recommendation is 20% down. On a $500,000 property, that's $100,000 in cash. Let that sink in. $100,000 sitting in your bank account, ready to hand over at closing. Just the starting point. According to recent data, the median savings account balance in America is around $8,000. That means the average person is $92,000 short. Not a little short, $92,000 short. It's an almost impossible gap to bridge for most working families today. But I'll just save for it, you might think. Let's run that scenario. If you're earning $84,000 annually and manage to save 10%, which is already more than most people achieve, you're putting away $8,400 per year toward your dream home down payment. At that rate, you'll need nearly 12 years to save $100,000. And that's assuming housing prices freeze exactly where they are today, which has literally never happened in modern economic history. Prices keep climbing while you are trying to catch up. It's a moving target that accelerates away. So most people don't put down 20%. They put down 5%, maybe 10%, because that's what's actually achievable in the real world. Congratulations, you've just unlocked a new monthly expense called PMI, private mortgage insurance, another cost added to your already stretched budget. This insurance costs you anywhere from $200 to $400 per month. And here's the kicker. It protects the lender, not you. You're paying extra every month because you weren't wealthy enough to put down 20%. It's essentially a fee for not being rich already. Let's say you've scraped together a 10% down payment, that's $50,000, leaving you with a $450,000 mortgage to finance. With interest rates hovering between 6% and 7% depending on your credit score, your monthly mortgage payment lands somewhere around $2,750 to $2,900. But that's just principal and interest. That number includes absolutely nothing else required to actually live in this house you just bought. Property taxes vary wildly by location, but let's be conservative and say $500 per month. That's your baseline tax obligation annually. Homeowners insurance, which is skyrocketed thanks to climate-related risks, runs another $250 to $350 monthly, another unavoidable expense. Then there's maintenance, the expense everyone forgets until something breaks at the worst possible time. Furnaces fail, roofs leak, pipes burst without warning. The standard rule is to budget 1% of your home's value annually for maintenance and repairs. On a $500,000 house, that's $5,000 per year, or roughly $420 per month. And don't forget that PMI we mentioned, add another $300. Let's add it up. Mortgage, $2,850. Property taxes, $500. Insurance, $300. Maintenance, $420. PMI, $300. Total monthly housing cost, $4,370. That's your real number every single month without fail. And this assumes nothing major breaks, you don't need a new roof, and there's no surprise HOA assessment for repaving the parking lot suddenly. Financial advisors typically recommend spending no more than 28% of your gross monthly income on housing costs. That's the traditional safe threshold. Banks will approve you if your total debt-to-income ratio stays under 43%. They're willing to stretch you further than advisors recommend. Let's reverse engineer this. If you're spending $4,370 monthly on housing, and that represents 28% of your income, you need to earn approximately $187,000 per year. That's what the conservative recommendation actually requires from your salary. Using the more lenient 43% threshold, you'd still need roughly $150,000 annually just to qualify under bank standards. Here's the uncomfortable statistic. Only about 10 to 20% of households in the US earn $150,000 or more per year. In the UK, fewer than 5% of households earn over £100,000. In Canada, it's roughly 10% above 150,000 Canadian dollars. This means 80 to 90% of households cannot comfortably afford a $500,000 home by any reasonable financial standard whatsoever. This isn't opinion. This is mathematics being brutally honest. The numbers simply don't work for the vast majority of people trying to buy homes. Let me show you what this looks like in practice. Meet a household we'll call the Smiths. Two working professionals earning a combined $160,000 annually. That puts them well above median income, solidly upper middle class. They should be comfortable, right? They're doing everything society says leads to success. Their gross income of $160,000 looks impressive on paper, but after federal taxes, state taxes, Social Security, and a modest retirement contribution, they're taking home around $9,500 per month. That's their actual spending money after all the mandatory deductions are removed. Subtract that $4,370 housing cost, and they're left with $5,130 for everything else in their lives. 2 car payments, both need to commute, $800. Auto insurance, $250. Fuel, $300. Student loans, $600. Health insurance premiums, $400. Groceries, $800. Utilities like electric, water, gas, internet, phones, $450 monthly. They're down to $1,530 remaining. We haven't touched clothing, entertainment, kids' activities, car repairs, medical copays, or enjoying life occasionally. Savings, emergency fund, retirement beyond that minimal contribution? Nearly impossible. The math just doesn't leave room for building any real financial security at all. This household is spending 46% of their take-home pay on housing. These aren't irresponsible people making frivolous purchases or living beyond their means. They're just trying to live in what the market tells them is a normal house, a basic 3-bedroom home in a decent area. Here's the daily reality of being house poor. It feels like checking your bank balance before grocery shopping. Every purchase becomes a calculated risk assessment. It feels like telling your kids they can't do that extracurricular activity because the $40 monthly fee might be needed if the car breaks down. It feels like lying awake at night doing mental calculations about whether you can afford new tires this month or if you need to wait and just drive carefully. It's being one unexpected expense away from crisis mode, living on the edge constantly without any cushion for emergencies. The HVAC system fails? That's $5,000 you don't have. Someone rear-ends you and your deductible is $1,000? Credit card time. Your child needs orthodontic work? You're financing dental care like it's a vehicle purchase, breaking it into monthly payments you can barely afford either. This is the reality for households earning $160,000 trying to own a $500,000 home, high earners struggling constantly. Now imagine what it looks like at $120,000, $100,000, or the actual median income of $84,000 annually. At median income, buying a $500,000 house isn't tight, it's not stretching, it's financial impossibility. The math just doesn't exist. Here's what makes this truly problematic. Nobody in the transaction has an incentive to tell you the truth about what you can actually afford long-term. Sellers listed $500,000 because comparable homes sold for that. Banks approve you at 43% debt to income because the loan won't default immediately. Real estate agents encourage you to stretch because their commission depends on closing the deal. The entire system is designed to get you into the house, not to ensure you can sustainably afford it long term. Nobody profits from your financial stability. They profit from the transaction happening right now. And once you're in, once you've signed those documents and moved your belongings, you're locked in. There's no easy escape route from this commitment. You can't just decide 6 months later that this was a mistake without destroying your credit and losing your down payment. You're trapped financially. So people stay. They stay in homes they can't afford, working jobs they can't leave because any income disruption is catastrophic to everything. Slowly watching their savings disappear, every month draining resources that could have built wealth, security, or opportunities for their family's future instead. For approximately 70 to 80% of households, a $500,000 home is not affordable, not sustainably, not without accepting dangerous financial instability, not without accepting a level of financial instability that would have been considered reckless a generation ago. The standards have shifted dramatically downwards somehow. This isn't about personal failure. This isn't about not working hard enough or lacking financial discipline. This is about a housing market completely disconnected from reality. This is about a housing market that is completely disconnected from income reality. The relationship between earnings and housing costs has fundamentally broken down. Home prices have increased roughly 400% since 1990. Median household income has risen about 180% in the same period. The mathematics cannot work. It will not work. Yet we keep pretending it does. Society continues selling the same outdated dream to new generations. We keep telling people that homeownership is essential for building wealth, which is technically accurate, but ignores the part where you have to survive first. You have to survive the mortgage first. We perpetuate the myth that if you just budget better and work harder, you can make it happen. But you cannot budget your way out of a structural affordability crisis. No amount of personal responsibility fixes broken market fundamentals and economic imbalances. So what's the practical takeaway here? If you're looking at a $500,000 house right now and your household income is below $140,000, you need to seriously reconsider. I don't care what the mortgage broker says you're approved for. I don't care what your real estate agent claims. I don't care what's normal in your market. The numbers are the numbers, and they don't care about your feelings or your vision. Or your vision for the perfect kitchen. Here's what actually happens when you ignore this advice. You stretch. You convince yourself it'll work out somehow. Month 1, you make the payment. Month 2, same thing. Then month 4, your car needs repairs. That's $800 you didn't budget for. You put it on a credit card. Month 7, the air conditioning fails in summer. The repair quote is $3,500. You don't have it. You finance it. Month 9, one spouse's hours that reduced. Suddenly, you're $600 short monthly. And that emergency fund you were supposed to build? It never materialized because there was nothing left to save. Every dollar was already allocated before the month even started. No cushion whatsoever exists. This is being house poor. You technically own a home, though the bank really owns it for the next 30 years, but you cannot afford it. You cannot afford to live in it comfortably. You cannot afford to maintain it properly. Every unexpected expense becomes a crisis that threatens everything you've built. Let me give you permission to do something radical. You can choose not to play this game. You can look at a $500,000 house, run the actual numbers, and decide it's not worth sacrificing your financial stability and mental health. That's a completely valid choice to make today. You can continue renting. You can save aggressively and wait for better conditions. You can explore less expensive markets or smaller properties that fit your budget. You can acknowledge that traditional homeownership has become something unrecognizable and possibly unattainable for many people, and that's not your fault at all. Because here's what actually builds wealth. It's not owning a house you can barely afford. It's having margin in your budget for opportunities and emergencies. It's being able to invest consistently. It's not having to choose between fixing your roof and contributing to retirement. Those shouldn't be competing priorities ever. Real wealth is freedom, not equity you cannot access because you're trapped by the asset that's supposed to be making you wealthy instead. The financial industry has done an incredible job convincing people that homeownership is always the right move, that buying is always better than renting forever, that you should stretch as far as possible because homes always appreciate. But they're selling you a product. They profit when you buy, period. Not when you make smart decisions. The bank makes money on your 30-year mortgage. The real estate agent makes money on the sale price itself. Nobody in that equation makes money when you say, "No thanks, this doesn't work for me." Your financial well-being isn't their priority at all. If you're sitting there right now feeling priced out, feeling like homeownership is slipping away, feeling like you're failing at some fundamental adult milestone, understand this. You're not failing. The system is failing you. The economic structure has broken down, not your personal character or work ethic. A $500,000 house is not a starter home. It's not affordable on median income. It's not something you should stretch for carelessly, unless you genuinely have the income to support it without financial gymnastics. Run your real numbers. Factor in all costs. Be honest about income stability. And if the mathematics doesn't work, walk away. There is no shame in saying, "This doesn't make sense for me right now." That's wisdom. Stop looking at what you qualify for and start looking at what you can genuinely afford without turning your life into a financial tightrope act. Find the number where you can pay the mortgage, handle maintenance, save for emergencies, invest for retirement, and still remember what it feels like to not stress about money. For most people, that number is nowhere near $500,000, and that's completely acceptable. There's no shame here. The housing market will keep pretending these prices make sense. Banks will keep approving loans that shouldn't exist, but you don't have to participate. You don't have to participate in collective financial insanity just because everyone else is. Sometimes the smartest move is recognizing when the game is rigged and choosing not to play. If you found this breakdown helpful, make sure to subscribe for more honest financial analysis that cuts through the noise. Drop a comment below with your thoughts on the housing market in your area. And remember, being realistic about what you can afford isn't failing at adulthood. It's succeeding at mathematics. Making smart decisions based on real numbers, not wishful thinking or societal pressure to conform.